Deep and irrational fear, driven purely by speculation, continues to dominate financial markets. This major drop in the S&P 500, just like Bitcoin's decline, is it signaling an extended bear market. In a scenario where the Treasury Secretary, just yesterday, did not rule out a U.S. recession, where business leaders express deep pessimism regarding the trade war, economic growth, inflation, and corporate profits. And why is Bitcoin's bullish breakout beyond its macro uptrend channel so significant? More importantly, what could its recovery and subsequent validation mean? A selling opportunity or a buying opportunity? As you know, since January 20th, Bitcoin has dropped approximately 24%. This decline has been fueled by extremely negative news, which of course has affected the entire crypto ecosystem. Events like the historic Bybit hack, along with traditional market factors, especially the ongoing tariff war under Donald Trump, are contributing to an aggressive bear market, driving retail investors into a state of deep panic. As we've analyzed in previous videos, we're in a time when every morning we wake up to news that retail investors perceive as negative, or even extremely negative. Just yesterday, Sunday, March 16th, U.S. Treasury Secretary Scott Bessent did not rule out the possibility of a recession. He stated that he wasn't concerned about the stock market's decline, which has been driven by uncertainty surrounding President Trump's tariff policies. During an interview on Meet the Press, Bessent said, "There are no guarantees. Who could have predicted COVID? What I can predict is that we're implementing strong long-term policies. Could there be an adjustment? Yes." He also emphasized that the massive public spending under Joe Biden's administration from 2021 to 25 must come to an end. Bessent pointed out that while a recession cannot be ruled out entirely, there is no fundamental reason why it should happen. He further claimed that if the country had continued on the same path under the Democratic administration, it would have faced a financial crisis. The Treasury Secretary also stated that he isn't worried about stock market behavior. Having spent 35 years in the investment sector, he assured that market corrections are healthy, normal, and not a cause for concern. He added that, in the long run, if the right fiscal policies, deregulation, and energy security measures are implemented, the markets will perform exceptionally well. Analyzing the Treasury Secretary's statements, everything suggests that the United States is not deliberately trying to trigger a financial recession, despite the intense speculation that flooded the media just days ago. However, what he did say this time, and this is key, is that there are no guarantees that a recession won't happen now. And honestly, that response seems reasonable in any macroeconomic situation the U.S. might face at any given time. It actually appears to be part of a broader propaganda campaign aimed at the countries they are currently clashing with: Mexico, Canada, China, and the European Union. Since they are in a tug-of-war with all these nations amid an ongoing trade war, it wouldn't make sense for them to publicly announce any market intervention to stop the stock market decline. If such an intervention were not accompanied by a reduction in the international tariff pressure spearheaded by Donald Trump, they would only be worsening their own state deficit. So for now, it seems more like a mix of propaganda and realistic statements strategically used for international negotiations. But I would never assume they are outright confirming or justifying an inevitable economic recession in 2025. Meanwhile, the wave of negative news surrounding the stock market isn't slowing down. As I mentioned before, every day we're hit with alarmist headlines. Take PricewaterhouseCoopers, for example. Through a recent survey, they report that business leaders are sounding the alarm over the trade war. They warn that its effects could slow global growth, drive inflation higher, and erode corporate profits. The report, based on the opinions of 450 experts, business owners, and executives, analyzes the economic impact of geopolitical shifts. It concludes that 72% of respondents expect a selective increase in tariffs between the U.S. and its trade partners. If you stop to think about it, these numbers are truly shocking. This is a clear reflection of the deep fears spreading worldwide. How is it possible that 72%, a highly representative figure, anticipate a selective tariff hike? What we're seeing here is a high level of certainty about something that, at this moment, does not yet exist. These market conditions we are dealing with now exist only in people's minds, and that's crucial to understand. According to the report, while the consumer price index stood at around 3% in February, by year-end, 40% of analysts fear inflation will surpass that threshold, signaling that price stability is far from assured. The report also highlights how these tensions have fueled a surge in protectionism and the restructuring of global supply chains. That's why 81% of the panelists believe companies will relocate their production to closer regions to minimize risks. At the same time, new trade routes are expected to gain traction, such as the Arctic route, the Trans-African Corridor, and the new Silk Road. Now, let's pause for a moment and think about this. Of course, it's alarming that 81% of these major business leaders are considering relocating their production. It's alarming, but it's also understandable. One thing is analyzing financial markets, how the S&P 500, NASDAQ, and by extension, Bitcoin can be affected by all these macroeconomic factors. But it's a completely different reality for business owners operating in the trenches every day, where trade policy decisions have an immediate and tangible impact. Companies operate in the short term, making instant decisions based on immediate challenges. Meanwhile, trade war policies shift shift constantly, and we still don't know in which direction they will go. For a serious impact to occur, this tariff war would need to escalate and be prolonged, something we cannot predict at this point. However, the traditional market seems to be pricing it in as if it already knows the outcome. So, in a scenario where the trade war doesn't escalate further, all possible effects may have already been factored in. And as I mentioned earlier, it's completely natural for businesses to react instantly because they are already facing real problems today. What truly matters is whether this pressure on US and international companies lasts long enough to trigger something severe. But if we take a step back and analyze, that remains uncertain. That's why it's wise not to get caught up in the panic or assume something as fact when, at this moment, it simply cannot be confirmed. And more importantly, let's not forget a key date, April 2nd. This will be a pivotal moment for tariffs. After the White House's recent decision to delay duties on the Mexican and Canadian auto industries, April 2nd now stands as the next critical deadline for tariff impositions in the sector. At the same time, Trump has announced that this date will also serve as the final deadline for imposing broader reciprocal tariffs on other countries that currently tax U.S. products. So, mark this date on your calendar. April 2nd will be crucial. It will determine whether the situation keeps escalating until something breaks or whether tensions begin to ease. If the latter happens, then the market may have already priced in all possible impacts of the tariff dispute. Now, the big question is, where do cryptocurrencies stand in all of this? And what can we expect for Bitcoin in the medium and long term? Let's analyze that next, but first...
Welcome to Crypto Insight, your ethical and moral channel for cryptocurrency technical analysis. Here, we really know what we're talking about. We conduct advanced technical analysis that has been developed for over 12 years. We upload videos several times a week. If you're enjoying what you're seeing, let me know and leave a comment with your opinion. Like the video, subscribe to the channel, and click on the bell so you don't miss the next opportunity.
Let's quickly analyze how the traditional market is behaving in this daily chart, specifically the S&P 500, after experiencing this significant 10% drop, could now be at a structurally key price level. This would justify the bearish move and the breakdown of this support zone. At the same time, we see a projected institutional target from this entire distribution phase. As we know, large institutions typically project a 1-to-1 target. And look at how the price has reached the 1-to-1 level and is now reacting to it. This leads us to consider the hypothesis. Are we witnessing a potential market bottom? Do we have guarantees that this is the absolute bottom? Of course not. If someone does, please give me a call. But at the very least, this is an interesting scenario. If we take a look at the Nasdaq, we see a very similar situation. We're at the base of this well-defined bullish channel, which justifies the recent bearish move below this support area. This could indicate that the move is setting up a structural trap, potentially paving the way for a recovery in the future, especially after all the extreme fear that's been dominating the markets. And in case you're wondering, could we still experience a breakdown, a climactic move, a final shakeout before a recovery? Absolutely. This scenario applies not just to the Nasdaq, but also to the S&P 500 and, as we'll see shortly, to crypto as well. Now, take a look at the Dow Jones. It has also lost its support zone, which is a normal occurrence. This could suggest that we are witnessing a market trap, meaning a potential market bottom. And what we're seeing after this phase of reaccumulation is that, by mapping out a volume profile, we've identified a high interest zone for institutional trading. Projecting that zone forward, we can see that the Dow Jones has revisited it, which further justifies this move, or rather, this overextension beyond the support zone, reinforcing the hypothesis of a potential market trap. And as I mentioned earlier with the Nasdaq, why not? Why wouldn't this be a trap? In fact, we could be seeing a trap within a trap. There couldn't be a more extreme market scenario than this. And once again, this invites us to consider that if we currently have a bullish outlook on equities and believe we may be at a market bottom, we must be ready to abandon that idea the moment price action shows something unexpected. If that happens, we'll be extremely quick to flip our stance and start supporting the bearish direction. And yes, at that point, we could truly start talking about a black swan event. But as of today, that black swan event hasn't appeared. And being at this market extreme, we're actually looking at strong long-term bullish opportunities, not just in traditional markets, but also in crypto. Now, I want to invite you to take the opposite approach with Bitcoin. Let's challenge the ideas we've been working with. If we switch to Bitcoin's weekly chart, we can see that we've reclaimed a macro structure that we had identified a few months ago. I'm talking about a macro bullish channel. If we bring it back onto the chart, we notice that after Bitcoin hit its all-time high, it failed to maintain upward momentum. And what's more than evident here is that institutions distributed outside of the structure, leading to a very aggressive bearish impulse. Why am I showing you this? Because we can't afford to get stuck or emotionally attached to a single idea. Yes, we've had a bullish bias for quite some time now, but we can't blindfold ourselves and only interpret interpret the chart based on what we want to see. So let's do a simple exercise. Let's switch to the daily time frame. Looking at it clearly, this has been a distribution phase, and when we analyze price action through the lens of smart money intent, we can identify the true objective behind this manipulation. Where did they want to take the price? By identifying these structures, we can see that the institutional target was precisely at $76,850. If you pay close attention, after breaking the distribution's creek, price didn't quite reach the target by a fraction, then came back to test the origin of the breakdown. And in theory, this should have triggered a massive crypto meltdown. But what actually happened? Institutions simply came back to grab that missed target as if they had left it behind. So what does all of this mean? It means that from a macro perspective, recovering this structure is absolutely crucial. We don't care how it happens, but if we want to avoid shifting into a bearish market, we need to see a full recovery. This is crucial. And if it happens, I can already tell you we'll end up removing this macro bullish channel ceiling because it will have served its purpose. Now, if we're in a fear-driven environment where we're trying to find the bottom in traditional markets to trigger a reversal, and knowing that crypto has a strong correlation with equities, where would Bitcoin and the rest of the crypto market find their temporary bottom? And more importantly, what do we need to see on the chart to rule out this hypothesis? Because let's be clear, no one knows the absolute truth or the future. What I can do is share our perspective and tell you exactly what to watch in the short to medium term to determine whether the bullish thesis still holds, or if we need to scrap it and start looking lower. To do that, let's move to the 1 hour chart. But first, I want to introduce you to our private Telegram channel, which is completely free. In fact, at the time of recording this video, we're also live streaming for the community. During these live sessions, we look for trading opportunities in the futures market. We focus on intraday trades, and within this community, members also share their operational ideas, what they're working on and what they're looking for in the markets at any given moment. It's honestly very interesting. This community is constantly learning and improving. So if you're an active trader and tired of trading alone, you can join our community. It's very simple. The requirements are as follows. You need to be a user of BitUnix or BuyDFI, have deposited cryptocurrencies into your BitUnix or BuyDFI accounts with a minimum value of $100, and use this account as your primary futures trading account. In other words, you need to be actively trading. Once you've met these requirements, simply fill out the form displayed on the screen. It consists of just 5 simple questions, and we'll get back to you as soon as possible. And what better time to do it than now? Our friends at BitUnix have set up an exclusive promo for new users where they'll cover up to $100 in losses. So if this is your first time trading and you're looking to join the Crypto Insight Premium Telegram channel, you might want to take advantage of this safety net in case of potential losses. Remember, BitUnix is an exchange that doesn't require kite and doesn't need a VPN to be accessed from anywhere in the world. To make things easier, I'm leaving you the BitUnix promo details in the Crypto Insight Premium Access form in the description and pinned comment of this video. On Bitcoin's hourly chart, we're evaluating the price action following the bearish impulse that broke a macro distribution, then came back to test the origin of the breakdown. And since then, price has been moving in an indecisive manner. So we've drawn and analyzed a volume profile. Why? To determine whether we're seeing an accumulation process that could lead to upside movement, or if we need to discard that idea entirely. Now, let me highlight the value area of this entire range. Here's what's important to understand. In a hypothetical scenario where we've already had the spring, in other words, that final push outside of the value area, one that creates a structural trap while simultaneously seeking the institutional target of the entire macro distribution. This invites us to consider the possibility, and listen carefully to how I'm phrasing this, because it's conditional, that this could be a low before we see a positive imbalance to the upside. But of course, all of this sounds great in theory, so let's analyze it properly. First, let's focus on how this major bearish move ended. Pay close attention. Toward the final leg of this downtrend, we saw a significant spike in volume and a delta heavily skewed towards sell pressure. Yet despite that, price failed to immediately break lower. So I have to ask, where is that selling pressure that failed to continue the move? And even more importantly, could institutions be absorbing this drop right now? If we analyze these recent declines, we see they came with high volume and a clearly bearish delta. Yet once again, there's no immediate continuation. So it's possible that institutions are absorbing all this downside liquidity with passive orders, limit orders, not market orders. That's why the delta is showing so much red. This is how we can assess this type of hypothesis. Now, does that mean that just because we've seen these reactions we're ready to move up? Of course not. If institutions decide to, they can launch another strong attack. It could happen, or it might not. It depends on how equities behave. But if it does, that bearish push could be absorbed once again. Then we'll see if there's a legitimate attempt to push the price higher. But how do we measure these probabilities? Just like we do with our Crypto Insight Premium team, we're going to analyze the short term. What's happening here? And what insights can we gather to support or weaken these hypotheses? First, let's take a look at this order flow chart. This is still Bitcoin, now on the 4-hour time frame. We're going to break down these drops so you can see that I'm not making this up. Let's zoom in a bit to get a better look at what's happening inside. Now, look at this massive drop on the H4 chart, an aggressive move. And yet, we can clearly identify market buys coming in. The market looks like it's collapsing. Everything seems to be falling apart, and suddenly we see significant buying volume. just like we've seen in traditional markets. By analyzing the internal structure of these candles, we can see where those buy orders were placed. And if we scroll back to check other major sell-offs, look at this one in particular. The market was dropping aggressively with strong selling pressure. Look at how much selling volume we can identify at these points. There's a clear attempt to push lower. But it doesn't work. Instead, we see buying strength stepping in. First, they absorb the selling with passive orders, and once they've accumulated enough, they switch to active orders, executing aggressively, and take the whole market in the opposite direction. Here, I can clearly identify real institutional presence, not with those nonsense order blocks or the random rectangles people invent with ICT concepts. No, here we work with objective data, allowing us to actually track institutional movements. Now, look at this last aggressive bearish attack. Look at how selling pressure came in strong. But tell me, maybe I'm crazy, but I don't see price following through. Ask yourself who sold into that drop. Do you think those sellers are the type of market participants with the power to crash and manipulate the market? Or do they seem like traders who might have all the intention in the world but zero actual strength? The answer is pretty obvious, but I'll leave that for you to decide. Okay, so why am I showing you this? Because it's crucial to understand that these bearish attacks have been absorbed. Now, you might think, all right, let's go up then. But no, institutions can also fail. What we do know now is that there are players in the market absorbing these sell-offs with the intent to push prices higher. So how do we evaluate whether this institutional effort will succeed, or if they'll fail, triggering a strong and aggressive bearish black swan event? Because if these buyers absorbing sell pressure fail, then, my friends, there's nothing left to do. This could turn into a very ugly black swan scenario. That's why we need to monitor these institutions closely to see if they remain active in the market. If they do, we can maintain a bullish outlook. Now, if we analyze Bitcoin's latest drop, which is a structural trap targeting an institutional level, we need to evaluate this crick for the short to mid-term. It also seems that, once again, on a lower time frame, these sell-offs are being absorbed. The key question here is whether we're in that classic situation where price breaks the crick, forms a flat correction that fails, then re-enters the range to seek liquidity. And if you want to identify where real transactional interest lies, you need to use volume profiles, not some random liquidation heat maps from websites where you have no clue where their data even comes from. Let's be real. Be honest with yourself. You don't know where that data comes from, yet you rely on it. This isn't personal. I'm just trying to help you. And here we can see how, after that flat correction, price is heading toward that zone where, objectively and based on real data, we know there has been transactional interest. There are both buyers and sellers in that area, and after a certain period where price hasn't revisited the zone, there's a tendency to unwind positions in one direction or another. So this opens up a hypothesis for us. If buyers have been stepping in here, if absorption has been taking place for a long setup, we should expect either a strong and aggressive bullish breakout relatively soon, or at the very least, signs of strength. Now, if we take Ethereum as an example and consider that after this bearish impulse we might be forming a W pattern, then what we have here is a weak Y. And why not? Could we be on our way to that Z target? If we want to entertain this hypothesis, though we don't know if it will play out, what we need to watch for is whether Ethereum support zone holds. Because if Ethereum loses this support, and at the same time Bitcoin sees a significantly bearish move, then the idea of accumulation, a flat correction, a liquidity grab, and then a breakout to the upside wouldn't make as much sense anymore. It would invalidate the setup, as the retracement would be too deep. In that case, this entire institutional short-term framework would collapse, likely triggering a strong bearish move. So why not bet on that macro Z in Ethereum? And in Bitcoin as well, of course, but always with the understanding that we don't marry a single directional bias. We remain fully aware that if certain key structures break, institutions will pivot, reinforcing the opposite direction, which in this case would be bearish. And if you look closely, everything suggests that we are on the verge of major volatility in the markets. Just wait, you'll remember these words soon enough. Now tell me, what do you think about the crypto market? Are you more bullish or bearish? Every opinion is welcome, so leave your thoughts in the comments. And if you enjoyed this advanced technical analysis, something you won't find on any other YouTube channel, make sure to like the video, subscribe, and hit the notification bell so YouTube lets you know when I post future updates. Good luck with your trading, and I'll see you in Crypto Insight Premium. Good luck and see you next time.